Yeah, okay. Like I said, tonight we are looking at economic value added. A quick recap of our last class. We looked at divisional performance evaluation. We explained that we have companies that operate along divisional structure. A good example is Dangote, where you have a company being segmented or being structured along divisional segments or section. How do we assess performance of division? Precisely last week, we looked at financial performance evaluation method. We can use financial measures to evaluate divisional performance. Like Dangote, we have Dangote Salt, a division under Dangote Group. You have Dangote. You have Dangote Foods. Periodically, the management will try to estimate or to evaluate performance of each division. We now look at how do we evaluate divisional performance. We can use financial performance evaluation method. Last week, we looked at return on capital employed and residual income. Precisely tonight, we want to look at economic value added as a metric for divisional performance. Let me quickly say that economic value added is also a financial performance measure. What is economic value added? Economic value added is similar to residual income. The economic value added is very similar to residual income, except that the profit figure used is the economic profits, and the capital employed figure used is economic capital employed. Let's take that again. The economic value added is closely similar to residual income. However, when calculating economic value added, we don't use accounting profits. We use economic profits. And we don't use accounting capital employed. We use economic capital employed. The principle of economic value added is based on the idea that division should be assessed based on the value created for the owners of the business. The economic value added is based on the concept that a company exists in order to maximize wealth for the owners of the business. The objective of a business is to maximize wealth for the owner. In other words, if you are trying to determine an appropriate performance evaluation method, we should look at the performance evaluation method that is linked to creation of value to the owners of the business. We should look at performance measure that is directly linked to value creation. If you are trying to measure the performance of a division, you can look at the extent to which that division has created value for the owners of the business. If you are trying to determine the performance of a division, we can look at the extent to which that division has created value for the owners of the business. That is what performance metric try to measure. Unlike residual income, we make use of accounting profits minus interest charges. If you recall, if you have to calculate residual income, the formula is fits. That is your accounting, the profit before interest and tax. Accounting profit before interest and tax minus imputed interest charges. Now, if you are to calculate economic value added, economic value added is calculated as your net operating profit after tax minus, open a bracket, capital employed multiplied by the cost of capital. Your economic value added is calculated as the net operating profit after tax minus brackets open, capital employed multiplied by your cost of capital. This can be abbreviated as your economic value added, NOPAT, net operating profit after tax, minus capital employed, multiplied by your work. Your work is weighted average cost of capital. Okay, it's even stated here. Your work is weighted average cost of capital. Now, the question, how do we determine net operating profit after tax? The question is, how do we determine net operating profit after tax? Let me quickly say that there are several adjustments here. You have up to 60 adjustments based on the concept of economic value added. You have about 60 adjustments. However, the adjustment is summarized and attention is paid to the major adjustments. Why am I stressing this point? You might go to another textbook and see more than these adjustments. Deliberately, we have limited ourselves to what I can ask in a study pack, because the adjustment is over 60. Now, how do we compute net operating profit after tax? Please, let's look here. You are going to pick your profit after tax. You pick from your accounting profits, pick your profit after tax figure. This is denoted with letter X. Add back the following items. Add back non-cash items. The following items should be added back. One of them is accounting depreciation. If you are giving accounting depreciation, you are going to add it back. Depreciation is a non-cash item. Depreciation is an accounting convention. No money is leaving the company. If you compute depreciation annually, the company has gotten a non-current asset, maybe plants. You now calculate depreciation. That depreciation is an accounting convention. You are going to add back accounting depreciation. Number 2, provision for doubtful debt. Where you have provision for doubtful debt, the doubtful debt has not happened. When we say provision for doubtful debt, a company has made sales on credit. The customer has not paid. Maybe the customer will pay in 2 months' time or 3 months' time. We now make provision for likely doubtful debt. In reality, there is no cash involved in that provision. All provisions, they are accounting conventions. They do not represent cash flows. What economic value added is trying to do is to remove accounting conventions and assumptions where you have provision for doubtful debt, provision for deferred taxation, all your provisions, in as much as that event has not happened, you are going to add back. Other non-cash items, where the examiner says you have non-cash items beyond depreciation, you can also have non-cash items like notional rents. When we say notional rents, what do we understand by notional rents? Let me explain that briefly. If you are using your private property for business, you have a private property. Maybe you have gotten property from your parents by way of inheritance. You now use that property for business. In your book, you are going to have rents, monthly rents or annual rent payable. Part of the expenses you are going to record in your book is rental expenses. You are going to assume that you have rented that property. You now place rents in your accounting book. But in reality, you have not paid rents. No cash is leaving your pocket. That is what we call notional expenses. You are going to add this back when calculating EVA. Then your interest paid net of tax. Please watch out. You know you have profit after tax. That means we have paid interest. You are going to return interest paid net of tax, add back. Also, goodwill amortized. We are talking of value creation. If it is possible to place a value at the goodwill created, then we are going to add that goodwill as part of value. At times you pay for a product more than the naira amount of that product. Let me explain that briefly. Look at table water. You have Nestle Food table water. Check out the price of Nestle food table water compared to the prices of other companies' table water. Check out the selling price of Nestle food table water compared to the prices of other companies' table water. You will observe that Nestle food table water is higher in selling price. The selling price is higher. Some people will still prefer to buy Nestle food table water. Why? Goodwill. That extra amount paid is the goodwill Nestle food is enjoying. You can add back goodwill. It shouldn't be years. It creates confusion. In ICANN site, sorry, in ICANN study pack, it was placed there, but it shouldn't be there. Operating list shouldn't be there. When you have development cost, where you have development cost, development cost should be added back. Development cost should not be deducted. Example of development cost is training cost. When you have staff training should not be deducted as an expense. Where staff training has been deducted, this should be added back. Then the following items should be deducted. 1, economic depreciation. Less economic depreciation and less any impairment in the value of goodwill. Less any impairments in the value of goodwill. When you are done with the adjustment, you are going to get net operating profits after tax. That will be in cash term. Then you now go to your capital employed. What are the adjustments to our capital employed? What are these adjustments? Your capital employed is basically your total assets less current liabilities. Your capital employed is your total assets less current liabilities. You can also take equity funds plus long-term debt. You can also take equity fund plus long-term debt. The adjustment to your capital employed, like I said, we have several adjustments. But you are going to capitalize your operating must be capitalized. Just 1 minute. I want to shift it to that side. Do I have it there? Aha, look at it. Yes. Capital employed. The adjustment to your capital employed. Investment in intangibles. What are the intangibles? One is, if a company invests in training and development, it's going to have capital to the business. If a company have operating lease, even though that asset is not, you are going to capitalize it. You are going to capitalize it. Then your provisions. Your provisions. Addition during the year to provisions. That will be added back. Like I explained, that provision is an accounting assumption. It has not happened. Where you have provision for the deferred taxation, where you have provision for doubtful debt, and other provisions. Adjustment will be made, and this adjustment will be incorporated as part of capital employed. Lastly, off balance sheet financing and operating leases. I've mentioned this before. Where a company have operating lease, although ownership is not transferred, where a company has obtained operating lease, although ownership is not transferred, but the company is using that asset for business. That asset is used to create wealth. That asset will be added as part of capital employed in the business. Whatever is trying to emphasize is operating lease should not be seen as an expense. That asset is used to create value and is part of the capital the company has employed and should be added back. If you are dealing with this, I always exercise I always tell you to exercise caution because the adjustments you have here is many. And unless a scenario is created, please bear in mind what you are trying to determine. You require 3 variables to calculate ever. One is your net operating profit after tax. Bear in mind, you are trying to determine a cash profit. That cash profit that belongs to shareholders. If you say net operating profit after tax, a simple way of explaining it is a cash profit that belongs to providers of capital. Who are the providers of capital? Or who supplies capital to the business? The shareholders and the debt holders. Now ask yourself, I want to determine cash profit. This profit must belong to shareholders and debt holders. You now monitor your adjustments. Like we itemize your accounting depreciation is a non-cash flow, add it back. Your provisions, you are going to watch the provisions. Is the provision increasing? You are going to monitor 3 things here. 1, is the provision provided for the first time? 2, is the provision has it been existing before now? If yes, is it increasing or decreasing? Look at that thing. Provision, is it provided for the first time? If it's provided for the first time, you are going to add it back, full amounts. If it's provided for the first time, you are going to add back the whole provision for the full amount. Alternatively, and that means it has been existing in previous periods. You now ask yourself, provision increasing or decreasing? Usually, company makes additional provisions. The company is trying to be prudent with its profits. Usually, a company makes additional provision. If the provision is increasing, then you are going to determine the actual increase and add back. But if you have a situation where the provision is decreasing, if you have an unusual situation where provision is decreasing, then you cannot add back because we are not making more. We are not making more provisions. We are reducing provision. In this case, you are going to deduct. It's a bit of trying to understand the concept behind ever. When you get to your capital employee adjustment, you want to determine the capital the company has employed in the business. Bearing in mind, I need to remove accounting assumptions, all provisions and allowances are accounting assumptions. It has not happened. We make provision for deferred taxation, make provision for bad debt. In reality, these items do not involve cash flows. Then lastly, your cost of capital. Examiner may give you the cost of capital directly. At times, examiner may not give you directly. You might need to do small working. In some questions, examiner will give you cost of capital directly. Examiner will just give you the variables. Then you need to work on calculating your cost of capital. We are going to demonstrate both or we can show it as a way of explanation. To calculate your cost of capital, we call it weighted average cost of capital. Is the weighted average of cost of equity plus cost of debt. It is the weighted average of cost of equity plus your cost of debt. The weighted average of cost of equity and cost of debt. The weighted average of cost of equity and the cost of debt. You are going to determine the average of cost of equity plus the average of cost of debt. We now sum it together. Please remember, your cost of debt is calculated after tax. When you get to finance, God helping us, you are going to get more of this. But at this level, we try to keep it. If you have to calculate your work, it's simply cost of equity multiplied by percentage of equity, plus after tax cost of debt multiplied by percentage of debt. When we get to calculation, we should be able to do more on this. Now, any question, please? Any
Good
question,
evening.
please?
You were saying for provisions, we should look out for three scenarios. Please, I didn't get the last one.
Sorry, I can't hear you.
You said for provisions, we should look out for three scenarios.
Yeah, okay, Pascal.
Yes.
Your question, please.
You said for provisions, we should look out for three scenarios. So I didn't get the last one.
Okay. I said for provisions, watch out. Is it the first time the provision is made? Second scenario, is the provision increasing? Third scenario, is the provision reducing? The treatment, if it is made for the first time, is different for if the provision is increasing. That is, the provision has been existing before, but it's now increasing. It's also different if the provision is falling. So watch out for these three scenarios. The provision may be made for the first time, or the provision has been existing at previous accounting year, but is now increasing. Then third one, the provision has been existing before, is now reducing. Each of them will have their treatments. All right. Oh, excuse me, please. Any question, please? If there's none, let us look at.
Good evening, sir.
Yeah, Gabriel.
Sorry, I have a question. For the format, how do we know an item that add value? Because what you listed there, goodwill, amortized, development cost, and operating lease.
Item that add
value.
Let me see if I can go off small for.
If you can explain better those items so that in case this particular one you give is not given, so how do we identify those kind of items?
Okay, let me try and see. I'm trying to even move these things in dreamy form. Not allow me to move mine the way I like. I don't even like this. Before I have to speak, I want to show. Okay. You can stay here. Just 1 minute. I don't need it now. Stay here. Yeah, your question, Gabriel. How do we know the items that add value to business?
Yes, sir.
Like I said, these items, they are very many, and that create value for business. One of them is if you are able to measure goodwill in terms of cash. That goodwill will be added. That goodwill will be added. Let me see if I can take it from here. One of them is goodwill amortized. Goodwill is a measure of the price paid for a business in excess of the current cost. If your current price, if your asset was your business asset was 50 million, and I'm willing to pay 60 million for your company as a whole, that 10,000 represents goodwill. That is what I'm paying for your name. Developmental cost. If a company engage in development, research and development, if you engage in research and development, an expectation is that after that research, and if you launch the product should create value for us. Developmental cost. Research. Part of your developmental cost is training. If you are sent on training, if you have to go to abroad for training, your company will incur cost. That cost, the expectation is that if you come back, maybe you have spent 1 month or 2 months, if you come back to the work, the company expects you to create value, to add value. That cost the company incurred will not be treated as an expense. That is where we are going to. That cost will be capitalized. It's expected to create value. You are not going to charge that cost as an expense. That cost will be capitalized and amortized. Over the number of years, value is created. That will create value. If you talk of staff training, okay, we have mentioned that. In some cases, advertisement and promotion, like promotional adverts, we are going to incur cost. But under economic value added, we are not going to treat that cost as an expense immediately. A good example is, look at that who want to be a millionaire. That program was sponsored initially by, was it Nigerian Breweries? Nigerian Breweries sponsored that program then. Any cost incurred will not be treated as an expense. That advertisement will create value. When we say value, we expect that advertisement to lead to growth or rise in the company's sales. If we have incurred 20 million for that advertisement cost, whatever he's saying is, we should not charge that cost to expense immediately. We should capitalize the cost and amortize the cost over the number of value is created. Is it getting better, please? It's not an item that can be exhausted. In this environment, and in fairness to students, examiner always look at the major items. If you go to these concepts, you have up to 60 adjustments. But examiner pay attention to like the list we have given us here. So a better way to also do is, if you're able to look at different questions, it put us in a vantage position. Is that better, please?
Okay, sir. Yeah, thank you, sir.
Let's see how we can, let's see if you can take, I wish to take that 3 questions, if time permits. Look at this question. Illustration 1. Peter Drucker opined that until a business return profit that is greater than its cost of capital, it's up a loss. Look at it. According to Peter Drucker, a company must be able to generate profits above cost of capital. Therefore, experts have challenged accounting profits as a measure of increase in the value of a business, and has proposed a measure of real economic profits. In their view, this will lead to better measurement of the increase in value of a business during a given period of time. One method that has been suggested to measure economic profits is the economic value added. TIS Limited, TIS Nigeria Limited has presented the following: income statements and statement of financial position for the year ended 31st December 2018. You have the income statement, profit rental and tax, interest income, profit before tax, taxation, profit after tax, dividend paid, retained earnings. Your statement of financial position, you have non-current assets, you have current assets, you have your shareholders' funds. Your total assets, you have it, your shareholders' funds, money contributed by the ordinary shareholders, long-term and medium-term debt, money supplied by the debt holders, total capital employed, you have it. Notes: capital employed at the beginning of the year is 420. That is, on 1st January, the capital employed was 420 million. The company had non-capitalized lease That means the company has obtained lease. This lease has not been capitalized. We understand lease. The company has obtained lease at a cost of 24 million naira. These are not subject to depreciation. Number 3, the estimated cost of equity was 10%. Cost of debt, 7%. The company's target debt to equity ratio. The company target capital structure, 60% equity, 40% debt. Accounting depreciation was equal to economic depreciation. Look at that statement. There is no difference between accounting depreciation and economic depreciation. Next note. Other non-cash expense, 16 million. The company has decided to evaluate its performance using economic value-added approach. Discuss the perceived benefits of using economic value added to measure business performance. 10 marks. What are the advantages of using economic value added to measure business performance? Please, for examiner to attach 10 marks to this, you are going to try to write as many as possible. This was ICANN question 2019. For examiner to attach 10 marks to this, you are going to list as many as you can. What are the advantages? 1, it aligns interests of shareholders and managers closely. What are we trying to say? Economic value added is directly linked to wealth maximization objective. A company is in business to maximize the wealth of the shareholders. Economic value added is directly linked to the wealth maximization objective of a business entity. That is point number 1. Point number 2, it is a measure of performance. It provides a tool for financial performance measure. It can be used to measure value created. It can be used to measure value created. Four, it helps in improving profitability. Why do we say so? It allows divisional manager or a company to focus on what creates value for me as a business entity, even as a manager. You must understand what creates value for your company. If you want to be relevant in that company, you must ask yourself, maybe you are still, maybe at this level, you say, okay, you just collect your salary, you go home. A point will come, you are going to ask yourself, I need to know what creates value for this business. If I'm going to be relevant here, that will force manager to focus on what? What creates value for us? It can be used as a reward scheme system. Company can use economic value added to determine reward to give managers. They can ask you, what value are you creating for us? What value do you create for us? It is easy to understand and to use. Unlike accounting profits, accounting profit is subject to distortion. You can just be making provision. That's why it's easier to say you want to commit window dressing. Yes, it's easier with accounting profits. And you make provision. What has not happened? You can increase provision to reduce your profit now. You can do it deliberately. You can deliberately increase some provisions. That will now reduce your profits. But when you are talking of ever, it's a measure of value, cash. It recognizes the benefit of activities that create value. It helps management to focus on value creation. It can be used for investment appraisal. We can also use it for share valuation. Please, when you get back, we can't tell if it's going to be texted, but please try to be able to write 5. Then B, calculates the real economic profits. We are going to leave this, even though we have solution here. Even though we have solution here, we are going to navigate. I'll now demonstrate this, how it is calculated. Okay. And let's see how we can demonstrate this. Even though you have access to the solution, let us see how far we can demonstrate this ourselves now. We are required to calculate economic value added. What is the formula, please? What is the formula, please? Let's have the class interactive. The formula, your notepad.
Notepad minus capital employed.
Please open your book also. Minus bracket. Please open your book. Let us take it together. The advantage of this is that nobody sleeps in class. Capital employ. Although it might take some time, but capital employ multiplied by weighted average cost of capital. Do you have your formula stated? Now our books. Next, I need to get my notepads. Let me quickly say that not everything, oh, sorry. Let me quickly say that not everything okay. Now, my net profit. Please check. What is the net profit? Or my profit after tax, sorry. My profit after tax.
6.
Our profit after tax. I need to pick it. What is the figure?
66,000.
66,000.
46,200.
6,200.
Who is giving us wrong figure?
200.
Okay, I know what to do. I know what to do. I will have to pause. That's the challenge. You have to navigate two screens together now. Our profit after tax, 46,200. Not 66,000. So we come here. Our profit after tax. $46,000. 200. Add do we have depreciation in the question? Do we have depreciation in this question?
Yes, we do. Yes, we do. Calculated depreciation, which is equal to economic depreciation.
Are you giving any value?
No, they just say it's equal
No,
to
sir.
economic depreciation.
That means we don't need to adjust anything. As far as that is concerned. I don't need it.
How about your finance costs?
Depreciation is not available in this question. We are only told that depreciation is the same as accounting depreciation is same as depreciation. That means what you are going to add back is equal to what you are going to deduct.
Okay.
You know you are going to add back accounting depreciation. Then you are going to deduct economic depreciation. We can just ignore this item. We have non-cash expense. How much?
Non-cash.
How much?
16.
Look at note number 6. Add back your non-cash expense.
16 million.
I will come here. I need to add back my non-cash expense.
10 million. Yeah.
Non-cash. No, I don't like this size. So light. This is add back 16,000. Then go and check interest net of tax. The interest net of tax. That means that interest, we have paid interest of how much, please?
9,000.
Interest is 9,000.
9,000.
9,000, Abi. You come here, your 9,000 multiplied by, open another bracket, 1 minus the tax rate, multiplied by 1. 1 minus, what is the tax rate, please?
30%.
30%.
30%.
Okay.
0.3. Please get this out. 1 minus 0.3, that will give you 0.7. 0.7 multiplied by 9,000, what do you have?
6,300.
6,300.
300.
Adjustment is not too much here. Please look at it. we focus on the income statements. We picked our, look at it, we pick our profit after tax. We pick our interest cost net of tax. You come here. Note number 1, capital employed will not affect net operating profit after tax. Note number 2, capitalized, non-capitalized lease will not affect it. Note number 3, cost of equity and cost of debt, no, it will affect our note parts. Note number 4, our target capital structure, this will affect our work. Note number 5, accounting depreciation, equal economic depreciation. This is of no use to us because what we are adding is equal to what we are deducting. Is that clear, please?
Yeah.
Is that clear, please?
Yes, sir.
Then last note, non-cash expense. We have taken all the adjustments. In this question, only 2 adjustments will affect our note parts. Please look at it. In this question, only 2 adjustments. You can get your note parts. Addition of 4,200 plus 16,000. So 46,200, 16,000, and 3,300. Get your note parts. Your note parts.
68,500.
What do you have?
68,500.
500.
58.
68.
68,500.
Oh, 68.
Yes, sir.
That is the, don't worry.
68.
500. We have gotten our note parts. Yeah, thank you, Dorcas. Next. That means you have resolved this item. You have resolved note parts. Next, your capital employed. Next is your capital what employed. Move up small. We can come here now. Or I can use this side. Let's manage this side. Capital employed. You start with your opening balance. You start with your what? Opening balance. That was capital employed at the beginning of the year. Look at it. Capital employed at beginning, 420. Can we all see it?
Yes, sir. 420 million.
Pick your figures. Pick your figure. Come here. My opening balance at the beginning of the year. For 20 million. I will take for 20,000. Assuming 30 is up. Add lease assets. We have lease assets. That is capitalized. We need to capitalize the lease assets. What is the value of that lease asset, please? What is the value? Please look at it.
24 million.
24 million. You are going to add lease asset. Then look at it, non-cash. That means cash, your cash is part of your current asset. This non-cash item, add it back because cash is not involved. That means no cash is leaving the system. We have incurred some expenses. Like the example we gave, notional expenses, they fall under not non-cash. If you are using your personal property for business, even though you put rent in your book, that asset is part of the capital you have employed. Even though you are not paying anybody any cash, that asset is part of the capital the business has employed. We are going to add back 24 million and we are going to add back 16 million non-cash. I'll go back to the screen. I'll come here, my lease assets. $24,000. Then my non-cash, non-cash. How much? 16,000. What other items? Those are the items you needed. Yeah. Those are the items you needed. You come back here now. Please sum up what you have. Total. This is what we call economic capital employed. This is what we call economic capital employed, not accounting capital employed. Summation, please. 460, Abi. Now, I've gotten my notepad. I've gotten capital employed. I need to get my work.
Sorry, sir.
Yeah.
My network was bad. Like, I didn't guess why we added the non-cash expenses.
So which one now?
When we're for capital employed, we did opening balance, leased assets, and non-cash item.
Okay.
Non-cash expenses, rather.
Okay, let me ask a simple question.
Why do you
Let me ask you a simple question. Is your cash part of your asset or not?
It's part of the asset.
Now, under your current liability, your cash is part of your asset. Now, if you incur
Yes, sir.
and you don't pay cash out, is money leaving you?
No.
Let me also ask you,
If you
have gotten a property from your dad by way of inheritance, you now use that property for business. Are you going to pay rent to anybody?
No.
Now, that's correct. If you are preparing your income statement, are you going to record rent in your book or not?
You won't record it. Sir.
Are you going to record rent?
You did pay for it, so we won't record it.
We are not sure.
We didn't pay for it.
We are supposed to record rents. You know, you are going to assume that you have, you are now using your property for business. As an accountant, you are going to assume you have rented that property. You are going to put rent expense in your book. That expense will reduce your profits. If you don't put that rent, that means you are going to be paying higher tax. You are not going to assume that, okay, if I've rented this building, how much will this rent cost me? You now put a rent in your book. If you put a rent in your book, that will reduce your profits. In reality, you have not paid any rent out.
Okay.
That means no cash is leaving you.
Yeah. That means the
your note part, we are going to add it back. If you now get to capital employed, you have gotten an asset you have employed in the business. Have you not gotten an asset?
Yeah.
And you are not paying any cash expense out. Yeah. Since you are not paying that cash out, that money must be added back because you have employed that in your business. Please. Non-cash will be added back. Now, let me quickly add to it. When you look at some ICANN questions, one question, they didn't add rent. They didn't add this to capital employed. One solution, they didn't add non-cash expense. Subsequent solutions, they were now adding it. That first solution was actually wrong because if I've gotten property for my dad and I've used that property for business, that property is part of the capital I've employed. Even though I'm not paying rent. So please, you are going to add back so that we can manage. So like you said, we have gotten our notepad. We have gotten capital employed. Next is to get our work.
Sorry, sir.
Yes, ma.
Good evening.
I'm listening to you.
Okay, please, why are we not using this other capital employed of 495 million? The one under the statement
Yes,
of
ma.
financial. Please, why are we not using
Yes,
it?
ma. That is accounting capital employed. Under ever, accounting capital employed is not recognized. You are going to calculate economic capital employed. Under ever, accounting profit is not recognized. You are going to calculate economic profit. That economic profit is represented by note parts. Net operating profit after tax. Is that clear, ma?
Yes, sir.
Now, to calculate your work, your cost of equity multiplied by the percentage of equity. Please check the question. Note number 3 or 2, I'm not sure. Note number 3 and 4. What is cost of equity, please?
10%.
Cost of
10%.
equity, 10%.
Cost of equity.
No, this one is too. Okay. Our cost of equity, 10%. Multiplied by, what is the percentage of equity in that company?
60%.
You can take it as 0.6, or you can use 60 if you like, it doesn't matter. Your 60% is 0.6. Brackets plus, what is cost of debt? Yeah, check. What is cost of debt?
7%. 7%.
Now that 7% is before tax. We now calculate after tax. Your 7% multiplied by, what is the tax rate, please? 1 minus the tax, 0.3.
3.
This is what we call after tax cost of debt. You are going to get this multiplied by, what is the percentage of debt? Check.
40%.
40%. Can work this out.
Percentage.
Our work is 0.6 multiplied by 10. What do you have? That will give us 6% now, Abby. Is that not?
No.
0.6 multiplied by 10%. Oh, yeah. Oh. What do we have? Oh? People of God, what do we have?
We have
Check your calculator. 0.6 multiplied by 10. What do you have?
It's like 10%.
0.06.
What do you have? What do you have? 0.06, Abby? It's also
Yes, sir.
6% now.
Yeah.
Brackets. Now, please, we are going to do this first. 1 minus 0.3. What do you have? That will give you 0.7, Abi.
Yes, sir.
Now, that 0.7 multiplied by 7, what do you have? Point 0.7 multiplied by 7, what do you have?
4.049.
4.9%.
Multiply by 40%.
Multiply by 0.4. Now, 4.9 multiplied by 0.4, what do you have? 4.4 multiplied by 0.4, what do you have? 4.9. What you need to do is 4.9 multiplied by 0.4. You are going to get a figure. The figure you have plus 6. What do we have, please?
That's 0.0796.
0.0796. You are very correct.
Yeah.
That is your weighted average cost of capital. That is your weighted average cost of capital. You can compute your EVA now. Please be mindful. We have notepads, capital employed, we have WACC. Please be mindful, we can save this. We can save this working one. Working one. Let's move to another page. Now, let's get our answer out here. Our EVA, economic value added, is equal to, look at the formula notepad. Minus, please, I know there is a solution, though. But honestly, if you can try to also copy it in class. capital employed, it will make your revision much simpler. Multiply by I will come here. My notepad. We have 68,500 minus bracket capital employed 460,000 multiplied by my work 0.0796. Please give me final answer. Please, final answer. Apply your calculator and give me the final answer.
31,884. 31,884. 84.
4. Let me rewrite that. $31,000 884. Please, any question to what we have done? You can compare with the solution shared. Please, any question?
Sir, I have a question.
Yeah, please go ahead.
Yeah. Sir, you know, sometimes ICANN can be funny. What if in a situation where we are given like year 1, year 2, and we are given
that shouldn't be a question. Let us, we have like 3 questions to continue to practice.
Okay.
You understand? Not that they are funny. ICANN can test ICANN can test different scenarios. No, don't use the word funny. You are a member of the institute too. Is that clear, please?
Yes,
don't say our institute is funny. Because you are a member of that institute. But you can be faced with different scenarios. How do we navigate? Is that clear, please? Let us look at illustration 2. Let us look at illustration 2. Can you see my screen, please? Please confirm you can see my screen.
Yes, sir.
You can see Abby?
Yes, sir.
All right, let's look at illustration 2. Uzo Chooks, Nigerian Limited, is a company established 4 years ago to produce medical equipment. The income statement and statement of financial position for 2019 and 2020 as follows. You have the income statement. You also have statement of financial position. Other information. Look at other information. Information 1. Operating costs include, look at it too, this operating cost you have here. These operating costs include the following. Depreciation in 2019. Depreciation in 2020. Provision in 2019. Provision in 2020. We have research costs. The research cost was included in 2019 operating costs, but not in 2020. We have non-cash items. Economic depreciation is assessed to be 50.5 in 2020. Economic depreciation includes an appropriate amortization adjustment in previous years. So, include appropriate amortization adjustments. In previous years, it is assumed that economic depreciation and accounting depreciation were the same. They are not the same. Note number 2. Tax is cash paid in the current year. An adjustment of 2 million for deferred tax provisions. There was no provision, there were no deferred tax prior to 2020. That means that was the first time provision was made for deferred taxation. The provision for doubtful debt. The provision for doubtful debt was 2.5 million. Look at provision in the income statement. 1.2 million. In 2020. $1.2 million. But look at the provision in the statement of financial position. 2.5 million. Please be mindful. Research and development cost is not capitalized in the accounts. This cost has not been capitalized. It relates to a new project that will be developed for over 5 years and is expected to be of long-term benefit to the company. 2020 is the first year of the project. When you have research and development, we are going to capitalize it. When we say capitalize, you are going to spread the cost over the number of years benefit will be derived. The company had a non-capitalized lease in 2020. 18 million. These are not subject to depreciation. Cost of equity, 18. Cost of debt, pre-tax, 6%. Capital structure, equity 60, debt 40. The company had the opportunity to invest in solar projects. that will require the procurement of equipment worth 3 million in January 2020 and run for a period of 5 years with a salvage value of 0.5 million, generating a stable net cash flow of 0.85 million. The applicable cost of capital is the associated work of the company. Requirements A, compute and evaluate the company's performance using accounting rate of return. What is accounting rate of return? Please note, your accounting rate of return is calculated in the same manner as return on capital employed. Please note, your accounting rate of return is calculated in the same manner as return on capital employed. The only difference is accounting rate of return is calculated before the project, while return on capital employed is calculated after the project. Let me take that quickly. We are going to also try to demonstrate this. Look at the formula. The formula is average profits before interest and tax over average capital employed. Please look at that. I will take it to that platform for computation. Please allow me. Your accounting rates of return is equal to average profits before interest and tax divided by your average capital employed. Multiply by what? Multiply by $100. You now come here. Your average profit before interest and tax. You know you are given 2 years. Is check 2019. What was the profit before interest and tax? Oh, yeah. Check 2019. What was the profit before interest and tax? And check 2020. I can come here. Come to your income statement. Okay, please note too, your operating profit is also called, please note if you don't know, is also your profit before interest and tax. What is profit for 2019? Operating profit, 70 million. 2020, 80 million. Look for the average. That's what we call, you come here, let's look for the average. 70 million plus 80 million divided by 2. This is equal to 150 divided by 2. This is equal to 75 million. In case you are looking at that solution, is that clear, please? Your average capital employed average capital employed is equal to, yeah, you don't make any adjustment. Go to the question, please. Come here. Look at your capital employed. For the first one, what we call capital employed is these two. Shareholders' funds plus long-term debts. Look at the capital employed. 400 plus 100. How much, please? 400 plus 100. How much, please?
500.
Capital employed. That means when we say capital employed, capital contributed by the shareholders and capital contributed by the debt holders. By the shareholders, you have 400 million. By debt holders, you have 100 million. That will give us 500 million in 2019. Capital employed in 2020, 445 plus 100. That is 545. I can come to this place now and say capital employed. In 2019, 500 plus 2020, 545. I will now divide it by what? I will divide it by 2. Please work this out. What do you have? That will give me 1045, Abby, divided
Yes,
by 2. What do you have
That's
here?
522.5.
5 what? 5.
522.5.
You can compute your accounting return now. 75 divided by 522.5 multiplied by 100. Please, what do you have? Over 1. This is equal to. Yeah, work it out.
$14.35.
Oh yeah,
14.35%.
30.
14.35%.
Yeah, I can hear.
14 point. Yes.
8. Oh, 14.35. Okay. Yeah. Our answer here no, that was 2. $14.35 in percentage. This is your average accounting return. This working is to support or to explain what you have there. Any question to this, please? Any question to this, please? Next. We can save this. You have working to now look at requirement B. Requirement B says compute and evaluate the company's performance using economic value added. If you are faced with the question, do not be disturbed by the noise. State your formula out. Let's go to the working board. Let's expand this. Okay. Eva, what's the formula, please? What's the formula, please?
No part
Is equals to
Note part
minus capital employed times 1.
minus bracket
capital employed
capital employed. Multiply by weighted average cost of capital. I need to get my note parts.